If you save $100 every month starting at age 25, you might end up with about $65,000 by age 65. But if you wait just 10 years and start at 35, saving the exact same amount every month, you will end up with only about $30,000. You saved for 10 fewer years, but you lost more than half the money. That is compound interest at work. By the end of this video, you will understand exactly why starting earlier matters so much and how the math behind compound interest actually works. Compound interest is interest that earns interest. That sounds circular, but here is what it means. When you save or invest money, you earn interest on that money. Simple interest would mean you only earn interest on the original amount you put in. Compound interest means you also earn interest on the interest you already earned. Let me break that down. Imagine you put $1,000 into a savings account that pays 5% interest per year. At the end of year one, you earn $50 in interest. Your account now has $1,050. With simple interest, in year two, you would earn another $50 because you only earn interest on the original $1,000. But with compound interest, in year two, you earn interest on the full $1,050. So you earn 5% of $1,050, which is $52.50. It is only $2.50 more, but that tiny difference grows over time. In year three, you earn interest on $1,102.50, not just the original $1,000. Every year, your balance grows a little faster because you are earning interest on a bigger and bigger amount. The key idea is this. Compound interest turns your earned interest into new money that itself earns more interest. It creates a snowball effect. The longer you leave the money untouched, the bigger the snowball gets, and the faster it rolls downhill. Let me walk you through the numbers step by step so you can see how this plays out. Let us say you start with $1,000 and you add $200 every month. Your account pays 7% interest per year, compounded monthly. That means every month the account calculates 1/12 of 7% and adds it to your balance. 1/12 of 7% is about 0.58% per month. In month one, you deposit your initial $1,000. At the end of the month, you earn about $5.83 in interest. You also add your $200 monthly contribution. So you end month one with $1,205.83. In month two, you earn interest on that full balance, not just the original $1,000. So you earn about $7 in interest. Add your $200 contribution, and you end month two with $1,412.83. Notice that your interest earnings went up from $5.83 to $7, even though the interest rate did not change. That is because your balance grew. Now let us fast forward. After 1 year, you have deposited a total of $3,400, but your balance is $3,511 because you earned $111 in interest. After 5 years, you have deposited $14,400. Your balance is $16,800. You earned $2,400 just from compound interest. After 20 years, you have deposited $49,000, but your balance is over $104,000. You more than doubled your money. The compound interest contributed $55,000, more than you put in yourself. That is the power of time and compounding working together. A lot of people think compound interest only matters if you are investing in the stock market or some complicated financial product. That is not true. Compound interest works in regular savings accounts, certificates of deposit, bonds, retirement accounts, and yes, investments too. The concept is the same everywhere. If your money earns a return and that return stays in the account, it will earn its own return going forward. Another big misconception is that you need a huge starting amount for compounding to matter. People say things like, "I will start saving once I have more money." But the math works the same whether you start with $10 or $10,000. What matters most is time, not the size of your initial deposit. A small amount that compounds for 30 years will beat a large amount that compounds for 5 years, because time is the biggest factor in the equation. The earlier you start, the more time your money has to compound, and the less you actually have to contribute yourself to reach the same goal. Waiting to start is the single most expensive mistake you can make, because you cannot buy back lost time. Here is the one thing to remember. Compound interest rewards time more than it rewards money. The sooner you start, the more your money works for you instead of you working for your money. You do not need to be rich to benefit from compounding. You just need to start, and you need to leave the money alone long enough for the snowball to grow. That is how compound interest actually works. If this explanation helped you finally understand how compound interest works, consider subscribing so you do not miss the next video. Up next, we are breaking down the difference between good debt and bad debt, and why some borrowing can actually help you build wealth. Thanks for watching, and I will see you in the next one.